Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good afternoon. Apologies for being a couple minutes late, but the old boss man, Mr. Mucker himself, gave me a quick call before going live. But I will let everybody kind of dial in, and then we can rock and roll from there. Mitchell, absolute pleasure to have you on.
Hey, brother. Good to be here. Try to jump on for about a half hour before I have another call at 5, but
That
always
sounds
a
perfect.
pleasure.
That sounds perfect. We'll come to you first then, bud, okay?
Lead off.
Can you handle it? Jesus, I'm not giving
there's
you the
no way to follow trend, so I'll do my best.
And I'm not giving you the sign to bunt, all right? I want you to swing for the fences.
I'll try to risk manage around it. How about that?
That sounds good. Awesome. All right, so why don't we get into it? All right, so it's February 8th, 4:30 in the afternoon here on the East Coast. Welcome all. Hope everyone's having a great day and a great week. Zero DTEs, they go both ways, baby. Today was 481,000 contracts printing at 410. Those puts printed. So it goes both ways. We've seen them do calls. Now we've seen them do puts. And this thing is the real deal, right? Keith mentioned it on the macro show this morning. He's talked about it a couple times and keeps mentioning it in the RTAs. So, this is critical information here inside of the RTAs, where he's given us insights into what he's seeing on the board, what he's talking about with real kind of, with big time portfolio managers and hedge fund managers across the board. So, again, this is if you're not paying attention to the RTAs, I won't say it's directionally important in terms of what inventory he's going after. For instance, one of the ones that at the end of the day was in the REIT space, and he mentioned that on the macro show this morning, and then kind of went to the wood with it this afternoon. And so again, if you're not paying attention to not only the sectors and the general location in which where he's pivoting and positioning his portfolio, but also in the intricacies in regards to the coaching notes. This is critical information right now in this game where we are squarely in the chop bucket. I tweeted that out yesterday. It's the chop bucket. The top end of the risk range hasn't been kind of north of 23 in quite some time. And this morning, reiterating that. In fact, it was about 1769 to 2105 this morning. So that is a smidgen over 21 on the top end of the risk range on the VIX, and that should tell you exactly in terms of positioning and that kind of thing, that leaning more net neutral, net long, although Keith did pivot that and told us where he was in one of those coaching notes this afternoon. So again, I'm not going to divulge that information out here for free, but if you're interested in it, hedgeye.com or email support, you can go sign up for those RTAs. If you're looking at those RTAs more from a immediate term trading standpoint, totally cool. But I will say, and I've told this to many, many people, said it down in Miami Regional, those RTAs are absolute glimpses into what is actually transpiring out there in the market. So even if you're not trading your portfolio in that manner, as in touching it, a couple times a day or multiple times a day, just having those RTAs get delivered to your inbox or via the mobile app, again, it's better than any source of information you could get from, let alone CNBC or Market Watch or Wall Street Journal, in terms of what's actually transpiring out there in the marketplace. I know over the summertime when I was transitioning to the new role here, when I was on the golf course or just out and about with the family, those RTAs were critical for me in terms of knowing exactly what was going on, and I could read those and get that glimpse. So I just wanted to start off by saying that, reiterating the great job that coach has been doing in terms of trying to disseminate this information, and the very challenging environment that we're in terms of having to use sort of both sides of the brain, as I joked last night, but Keith reiterated this morning on the macro show. You can have all this economic data and quad four environments happening in terms of where we're at and the economic data that's rolling in, but the signal, or certainly in the near term, kind of using that side of the brain as well in regards to, as I mentioned, being kind of really pivoting on either side of net neutral on an almost daily basis, given what's happening in this chop bucket. But with that, I'll pass over to my man Mitchell from Other Side Asset Management, and he can kind of walk through what he's seeing right now, because I know you've got a little bit of a tight timeline, man.
That's all right. I'm probably seeing what many of you guys are seeing, and what Keith called out on the morning call. It's interesting. We talked about this last Wednesday, right? We talked about removing your biases from what you think should happen, right? So it's not as if Coach hasn't had 20 plus longs in the RTAs. I'm sorry, not in the RTAs, in the macro pro subscription. And if you don't subscribe to Macro Pro, last I checked, I think there were more longs than shorts in ETF Pro. I want to say that's how my notebook lined up the other day. So we're obviously very bearish. I think all of us are bearish who follow Hedgeye. At the same time, what we talked about last week is what Coach reiterated the past couple days. It's figuring out how to remove that bearish sentiment when you're staring at these ODTEs, when the risk ranges are when markets are moving past the risk ranges, it's doing things incrementally. It's not getting too full on certain things. It's position sizing, as you've reiterated last week. I reiterated last week. So yesterday was a frustrating day for me a little bit, because I was down slightly, a handful of basis points, but I'm net long. I'm just not net long the shit that was up, right? So I've tried to read the tea leaves from what Keith has been talking about, and I'm focusing my net longs more so on the quad four plays that have sold off in the past couple of days, and I've taken time to get bigger in them, right? So I have focused on gold getting bigger on the sell-off from last Thursday's number. I got bigger Thursday, I got bigger Friday, bigger on Friday than on Thursday. So I think that's the way you play it, right? As you get closer to the bottom end of the risk range, you get bigger. If you're waiting for the absolute bottom, that's not doing things incrementally, I don't think. But I got bigger in gold. I got bigger in treasuries. I added some duration. So yesterday, where my treasuries were not working, they were today, right? So IEF was up today, TLT was up today, ZROZ was up today. One of the things I didn't touch the past couple days was EPHE, because I don't know where trend is on that, but I had a feeling it was getting close, and today Coach reiterated EPHE on the call, or on the macro show, so I have not gotten rid of that. But I did get rid of PPLT yesterday or 2 days ago, and I think they just updated ETF Pro and it's out, right? So dollar getting a little overbought, as I think we've been noticing. Coach has been pretty clear in that, and those who follow the Macro Pro subscription saw it pretty much down on the list in terms of where Coach's re-ranking was. Oil, I did not short more today, but I am getting closer to shorting more. It's getting towards the top end of the risk range, if I'm not mistaken. Let me take a look. 78.475. Top end of the risk range is a little bit higher, but this is where I'll start incrementally laying out some, depending upon where it opens tomorrow and where the bottom end of the range possibly moves up to. But if I'm a betting guy, I'll probably be shorting a little bit more of that tomorrow. So I'm trying to stay away from the areas that the ODTEs affect, but at the same time, as you, myself, and X2 were kind of talking about behind the scenes, they go both ways on the ODTEs, and at the same time, the question becomes when is it the puts and when is it the calls, right? When are they going to bang the calls higher and when are they, knocking the puts lower? And I think that's just a function of paying attention. As you noted, 481,000 contracts on the puts at the 410s. That's huge, right? So I'll still, I call it what Keith calls it. It's outright manipulation, especially when you're banging them up 30 plus thousand, 40,000 contracts with 4 minutes left into the day. That's nothing but manipulation. And by the definition of the SEC, Securities Exchange Act of 34. So, I don't know. I mean, in the notebook this morning, Microsoft was $3 away from its top end of the risk range. Google was $3 away from the top end of its risk range, and Apple was $3 away from the top end of its risk range. Things everyone should notice. XLK was $2 away from the top end of its risk range. So shorting NASDAQ was the was how markets were lining up, just paying attention to the ODTEs, in my opinion. So yeah, I'm getting long duration here. I think proper quad 4, if we're not looking to trade, everything day to day. I think that's the longer term, more intermediate term trade from the standpoint of this deterioration in economic data is staring us squarely in the face. So the 30-year, 20-year, and 10-year should start to move lower off the top ends of its ranges. And the 2-year is probably going to stick pinned high based upon Fed no pivot. So that's kind of what I'm seeing. I'm staying towards the quad 4 plays, and many of those quad 4 plays will still or should still do well as we pivot to quad 1, where I don't think we're close. I think we see an absolute disaster moving forward, but we're going to risk manage today, not moving forward. But still, you're straddling quad 4, quad 1, if and when that eventually does pivot.
Yeah, exactly. I think that's nail on the head. One quick thing, though, on treasuries is that just that 10-year put in a lower low and a higher high this morning. So just keep an eye on that. This is where, sometimes that expanding risk range can it's kind of a reflection of price. So obviously, all these ranges are price, volume, and volatility. But the good news is move did, I think, kind of moved
down
a little bit down today.
Yep. 2.33% down.
Exactly. Yeah. So a few bips. So again, volatility is below trend. It's in the right. It's it's doing the right thing. But I just wanted to anytime you've got the top end of the risk range or bottom end, really,
right by the trend,
by trend on either side. So right now, absolutely, it's been added
to
the play. Yeah, it's been TLT, for instance, it's been added to the playbook. IEF as well, but again, this is sort of incrementally doing so until we get a little bit more confirmation. In terms of signal, what you're going to want to look for in that 10-year is both a lower low and a lower high, and then the immediate term top end of that risk range to be falling under the trend level. So again, just for those listening in that are looking for kind of clues as to maybe when Keith and or really one would potentially get a little bit bigger or have a little bit more, I guess, conviction is the right word, but conviction is the right word, but I don't really like using some of those old wall terminologies, right, Mitchell? But no, just in terms of like where the signal would be.
Confirmation that the signal is working.
Confirming, that's the word I'm looking for. You're the man. That's kind of the type of thing that you'd be looking for. So the yield curve is definitely doing its thing too at minus 81. So that bad boy just keeps getting more inverted, and it's quite something to behold. It's minus 11 basis points as of this morning on a month over month standpoint, and in percentage change terms, it's minus 16.3. So just keep an eye on that yield curve. That's the 10s and 2s for those listening in. The 2-year remains still bullish trading trend, and those with the 10-year and 30-year both bearish trends. So big pivots there. I said that would be a big thing we'd be talking about. Global yields are really confirming that. You're getting that kind of from hawkish standpoints out of multiple central banks. I believe India raised rates this morning. Canada reaffirmed that inflation is a key priority for them. So again, these central banks continue to do so. ECB was out as well. So this economic data, as I alluded to at the beginning of the call, is absolutely kind of rolling in quad four environment. And but you got to kind of manage this near-term risk and near-term components here with that sort of data in mind. So again, there's that's kind of we'll leave it at that. Yep,
just a couple quick notes. In adding duration, right? We can get up to 10% in a handful of different holdings. So I'm nowhere close to 10% in any of my holdings, right? So to your point, just keep an eye on where the 10-year is from the standpoint of trend, right? And as we get that confirmation via the signal, Keith's signal, and where trend is, and once we get below, once the top end of the range gets below trend, we will have a bit more of a confirmation. Then we can really get bigger on sell-offs, right? And then at the same time, dollar, 3 days in a row now putting in higher lows. Yes, lower highs, I get it. Yes, it's done this before, but I guess if we're talking out of the last 8 days, dating back to January 27th, where it moved from a 101.25 up to a 101.29 from the 26th into the 27th, outside of the February 2nd, it's now put in higher lows. So that doesn't mean jump in head first. It doesn't mean or take away anything that we talked about where it's intermediate term overbought. At the same time, that's what we want to be seeing in a quad four environment. So, or for dollar bulls, right? So as we start to see more and more of those, and then as we start to see the top end of the range move higher, that will give us more of a confirmation that the dollar may be poised to move higher at a more rapid pace. Just something to keep an eye on.
Yeah, and so just to elaborate on that, the risk range consolidation can often be a very good signal ahead of basically consolidation means typically a big component there is volatility coming out of that asset, right? So it's kind of and really it's because price isn't moving as much either, right? So this
right.
is that can be a very it can lead to kind of positive momentum to the top side, but it really kind of depends on the direction of that volatility. If volatility kind of blows back out, it can be it's a little tricky because it can be positive, like increased vol with up price momentum and up volume, but typically you would kind of like to see that volatility remaining kind of down and low with price moving higher on volume. So just keep an eye out there. Yeah, great call out on the dollar. I think that's really important. You're seeing a couple key kind of components kind of pivoting there in regards to, and really some divergences. And I shared some stuff that Chris Moyer tweeted out earlier this afternoon along those lines. So again, those are kind of his kind of data points and signals that he's kind of built on for himself. But I thought it'd be worthwhile, or obviously it's very worthwhile to kind of share all sorts of different data pieces from Hedgeye Nation, and I see Muni guys coming up too. So we'll talk Munis in a minute. Hedgehog's got their hand up. I'll go to you in just 1 second. Let me just finish this sort of thought on FX. So with FX, euro, the yen, the Canadian dollar, the British pound, the Canadian dollar is certainly from a signal standpoint putting in some lower, so kind of lower, kind of relatively flat day over day, but kind of on a week over week basis, lower lows and lower highs. That can correlate to the to oil. So keep that in mind. But there also is a lot of mining in Canada as well. So this could be one of those situations in Canada where you get a weaker oil, but perhaps stronger metals and mining complex. So that may be a bit of a wash there. But really, as I mentioned, the Canadian Central Bank is a likely has a bit more of an influence if they keep raising rates and stuff like that. What's going on there in currency land. But the pound to me is really one that probably stands out as a somewhat divergence here over the last sort of few days versus what we've seen the last few weeks to months in regards to the pound, and that is continued sort of like that's a lower low on a day-over-day basis. So again, this is one of these things where you want to see those lower lows and sort of the risk range potentially kind of widening a little bit, meaning volatility is returning or coming to that asset, and you could see for the downside risk. So yeah, just wanted to kind of highlight that on the FX side. Hedgehog, you got your hand raised. The floor is yours. Welcome.
Yeah, just a quick question. I've been doing the same thing as other side regarding gold and treasuries, but I was curious what you were doing with the miners. And also Keith this morning kind of made a cryptic comment that he doesn't expect the gold trend to hold necessarily. So I don't, if anyone can expand on that, that'd be good as well.
Is that question for me or for Robert?
Yeah, you can take it, Mitchell, if you want.
So I didn't get that out of Keith this morning. Maybe I missed it. It's definitely not what I got out of him from the standpoint of the mid-quarter update call yesterday. I don't know if you were on it, but
Hedgehog, yeah, Mitchell. I mean, sorry to interrupt, but I wrote down screamer equals the gold trade. So I don't. I'm gonna have to review that. You're talking about it holding trend? Is that what you heard?
I thought it was just a comment about by the way, I don't necessarily expect this to hold forever or something like that.
Well, maybe forever is after quad 4 into quad 1 or a different. I don't know. This I think I don't want to put words in Keith's mouth, nor do I want to give up something from the macro themes. But I think gold and the gold theme, in his opinion, is one of the best setups out there in all of global macro.
Yeah, I'll just reiterate what I said.
You don't want to get over your skis on it, right?
Screamer. The gold trade is a screamer play. So
it's the one that's
okay.
screaming.
So the gold trade is a screamer. So are the miners screamers as well?
Not all miners are created equal, right, Hedgehog? So
yeah, here's
I mean, he booted Silver Juniors this afternoon from ETF Pro. Right. I think on the gold miners certainly look more attractive and were added to the risk ranges this morning. They had been just in the out bucket. So again, I think that should give you another inclination as to the importance of GDX as an equity exposure.
At the same time, I'd piggyback off what Robert just said and try to answer your other question. I'm long more gold than I am gold miners and junior miners. So I will beta adjust those from the standpoint of I'll get much bigger in gold than I will miners and junior miners. And at the same time, I would reiterate or not reiterate, but keep in mind, if and when we get a VIX explosion, again, I'm expecting one. If and when we get it, I don't think anything's investable. So, I will definitely be keeping an eye on GVZ if and when that happens. At the same time, I will be very, very quick to pull miners and junior miners. If you go back to 2008, if you go back to 2020, when VIX exploded, everything sold off, including those, but they were also very quick to come back and recover. The miners and junior miners were very quick to recover. So I think in what could be a flush or a downdraft, just be careful and be mindful of how big you get in those. But at the same time, they're quad 4 plays, but the equity is much more volatile than gold itself. So I just play it from the standpoint of...
What I wanted to add to what Mitch said was the beta, 1-year beta on the junior miners GDXJ is 0.78. The beta on GDX, just the gold miners, is 0.49, while that on GLD, just gold, is 0.11. So when Mitch is saying about beta adjustment, pay attention, very important, that GLD is not the same as GDX, is not the same as GDXJ. keep in mind your beta, as well as keep in mind when equity sells off, GLD may hold, but GDX or GDXJ may not hold as compared
Correct.
to, yeah. So just keep that in mind. Just wanted to add that data, Mitch. Go ahead.
And
Yeah, no,
just
no.
on that, yeah, and on that point, I mean, on a beginner's guide on Friday, I reviewed a lot about volatility adjusting those positions as well. And my examples were gold, as in GLD, GDX, and then gold as in Barrett Gold, GOLD, using those as
Yep.
kind of three separate examples in the realized volatility component. So so Hedgehog, I think a key piece there is the equities will trade like equities, right? So at VIX 28, it's possible that they look a lot different than at VIX 19, 18, 20. So just keep
Right.
that in mind as you're reviewing, and then volatility, and not, so beta adjust, volatility adjust that sizing, so that if things do get a little offside there, or they take a hit with the spike in volatility, as in underlying VIX equity volatility, then they're sized appropriately, and that kind of thing. So just kind of keep that in mind. But in terms of overall exposure, and it was a big theme yesterday, was certainly gold, precious metals, and the related components and the exposures therein, to capture that full investing cycle.
Okay, well, that's how I'm positioned. So thanks for the
Yeah,
clarifications.
and it's early days too,
Yep.
right? Like don't we don't need to chase anything, right? You just kind of incrementally build upon those position sizing, and again, managing them on up days and down days and that kind of thing. So just
Hey,
go ahead.
Robert, before I jump, I want to ask you a
Yeah.
question. KM lightened up on a few of those earlier today. Now, my question is, did he lighten up on some of them because they're getting closer to trend, or because he was just moving some inventory? And then I got to jump for my 5. But do you have a thought on that, or am I reading too much into it?
I mean, I think so. They're up pretty big on the open, GLD, silver.
Okay.
So I would think, and I don't know this because I didn't specifically ask him this question today, but I would think that he went probably bigger in them into the close yesterday, and then just wanted to,
And he was able to slip out a little bit.
wanted to lighten up. Yeah, exactly right. So
Got it.
that would be
Okay, cool.
my take. I wouldn't really read too much into them. Their core exposures, going down. Yeah, their core exposures at the moment. So I would think that was more of a tactical move. And if you didn't make that move like him, I don't think it's obviously not a big deal. Everybody trades and leverages their portfolio and portfolio construction differently. But at the same time, be conscientious as to like what is your overall sizing and exposure. If we see some kind of potential weakness there, he kicked out silver juniors. So that signal, I don't know if they broke trend, but normally in ETF Pro, something breaks trend, it's out. Or if the signal just doesn't look as good, it's out. So it's kind of like twofold there. I know there's a question on the arena, like what do I do? If it's out of ETF Pro, it's for a reason.
Yep.
Hello?
Hey, Robert.
Yeah. Hey, Arthur. Sorry, can you guys hear me?
How you
For some
doing?
reason, my headphones
Yeah,
disconnected.
yeah. I think you went dead for a minute.
Oh, my bad.
I thought maybe you were just waiting for one of us to jump
No,
up.
my
But
fault. I don't know what happened.
no,
My headphones just disconnected randomly. So,
just the
can you hear me okay though, Arthur? Is everything good?
yeah, I can hear you.
Okay.
Yep.
I think all I was saying is that, the signal is the signal. So platinum, silver juniors, those got booted today. Just be, conscientious of those position sizing, especially as some of that weakness starts to show up.
Yeah, I just wanted to jump up since we're
Yeah.
talking, about what's going on here in the middle of the chop bucket, because I think that's really crucial when, at any point in time, you got to know where you are, which bucket you're in. And I don't know if this might help others, but over the years, what I've tried to do is if I'm going to go long or short in anything, before I put that on, or when I'm going to put that on, I already know what I got going against that or on the other side of that. Just as a rule, to help me, keep myself disciplined as far as not getting the portfolio construction too much, one way or another, particularly when you're in the chop bucket. So, I think the core one for me right now, given what I'm hearing from Hedgeye, is, you got your TLT, IEF long versus your junk and high yield short. I mean, those are perfectly, I think, beta adjusted, a great position to have on given, what I see coming down the road. But that's an example, so you have your, you can have crypto versus short something long, and, China long versus, some other beta that you want in the States, for example, short. So that framework, that mindset, I think is something I always like to try to do. And I force myself if I initiate a position, okay, so what's going to go? Do I have something against this? If I don't, what's it going to be? Does the beta look about right? And if the beta is off, but I still want to do it, then I adjust it as far as sizing. Just kind of the way I'm looking at things.
Yeah, that's great insight, Arthur. Absolutely, and I would echo that. Now, for those that can't go both ways, or that can't run a long short book, or are uncomfortable doing so, if you can't have something on the other side, again, just review what I would call volatility adjusting those positions / beta adjusting those positions. That's going to help with the swings to either the downside or the upside. And that's and review. We've talked about this a couple times, but reviewing what is your overall portfolio goal. Is it absolute returns? Is it risk manage? Is it more risk management, aka you're managing your nest egg for you and your family, or your retirement account, and you're really just trying to navigate the drawdown and minimize that. So if that's the case, then in this environment, regardless of whether you can go long short, having a strong a relatively strong cash position is a position. I tweeted this yesterday too. That is a decision, whether you act or don't act. Not acting in an environment is an action in and of itself. So just remember that it's not a big deal to be in cash. Like, it's okay. You can still be engaging on a regular basis, but not always pulling the trigger or putting on the trade, right, Trend, in terms of
I actually wanted to bring in the quote of Benoit Mandelbrot in this.
Please,
in the
love
book Misbehavior of Markets, he has a very interesting line that always stayed at the back of my head. And last year, when we started in January, if everybody remembers, if you were on the spaces, one of the things I mentioned was that the Fed gave us a huge gift in form of the expansion of balance sheet back in 2020, 2021, and I just wanted to preserve it. So the relevant quote from Benoit Mandelbrot from The Misbehavior of Markets, I still remember the page for some reason because I've referred that so many times. The line is as follows: "You cannot beat the market, says the standard market doctrine, granted, but you can sidestep its worst punches." So very critical to understand that you don't have to go short, right? And you can just sidestep the worst punches by just keeping a cash allocation available. And in cash, there's pretty cool funds available, such as VMFXX, which is a money market fund, in order to get really good yield over the next 4 months, 6 months, 1 year, in case if you're not comfortable or if you don't have any conviction on which way to go, especially given that we're trading at like 18, 19 forward P on the S&P while the estimates are coming down, not knowing where we're going to head. Right now, we do have a draft of net liquidity coming in from end of December through now, giving us these kind of, almost evisceration of the shorts resulting in this sort of situation. So definitely, if based on whatever your investment policy statement is, again, this is not an investment advice. I am not a fiduciary. You should do your own due diligence. You should consult your own financial advisor. But definitely, one can sidestep the worst punch from the market and still beat a lot of people in this business.
Hey, Trend, I was wondering if I could ask the board a comment on
Yeah, go
crypto
for it. Go
right
for it.
Yeah, crypto right now, the lower highs, higher lows, narrowing range, bearish trend. What does anyone on the board feel comfortable on a read on what's going on there? Because I'm having a tough time figuring that one out.
Was
Well,
that on?
I've been net
I
long.
missed. Sorry, Trent, I missed the first part. Was this on high yield growth?
No, Bitcoin.
Oh, Bitcoin. Sorry. Okay, thank you. Yeah, go ahead, Trent. I
Yeah.
apologize. I missed that first piece on like what we were referring to. Got it. Yep.
Yeah, no, I've been net long in general. I don't have a Bitcoin exposure at the moment, Arthur, but I've been net long risk on from January 10th, 11th timeframe, just because of a whole lot of signals that came my way in my process, right? My process uses inputs from Hedgeye process to augment it. So I have my own process, which I've shared with the community in the past. When Rob did that interview, it's on YouTube. If you just search on YouTube TrendViso, there's only one video that pops up. So at this moment, from a crypto standpoint, I don't have an exposure. Part of the reason is that when that whole saga began in early November between CZ and the FTX guy, SBF, at that point of time, I literally took out everything from Binance, everything from all other crypto locations, including Coinbase, and I did not leave anything on the exchanges. And as and when intraday, if I have to do any trades, I've shared with Rob in the past ones, I have a basket which I've created. I would just say, okay, 4% of this basket, boom, go and buy it, and then I would eventually close it at the end of the day. So especially on squeeze days, that basket kind of works out really well. At this moment, I have no view, but I do look out for Bitcoin and altcoin and that entire space as one of the really high frequency short term leading indicator for NASDAQ.
Yeah, they're pretty correlated. It's just the comment or trend. Forget I'm even talking about Bitcoin, but the idea of a higher low, lower high, narrowing range, bearish trend, high volatility asset like a Bitcoin or like Bito, or I don't know how you pronounce it. Keith's got on the board short right now, and I'm a little short with it too. And it's just kind of sitting there, making lower highs last 3 days and higher lows, and it's been moving down. And I'm just curious, anybody get a read on that, or any comment that I missed from Keith on that? Thanks.
Yeah, I don't. Anybody on the panel?
Oh, I'll talk crayons.
All right, let's do it. Let's do it. Let's talk crayons. I mean, you've heard a lot of my voice today, so let's pass the puck to
Oh,
Leslie.
no worries. Yeah, I got a couple things, but we can start with this. Again, I'm not a fiduciary. I draw lines on charts. For Bitcoin, there is a massive gap from that initial flush down from last June. And we are the bottom of that gap is right around 25,000, which is, of course, the law of big round numbers as well. So we flushed through there, came up, tried to get above it, couldn't, flushed further. This is the first attempt back up towards 25,000, and there's like very little volume in there. I'm just charting off the futures. I don't have the actual coin volume or volatility or anything. So what we have is kind of mean reversion back up to that level, and that's the spot to watch. Is if we can get in there, it's possible for it to go higher quickly, or it could just reject out of there and go back down. Just from a charting perspective. If anyone had anything to add on that?
Leslie, are you referring to the gap between 28,814 and
Yep.
27,609? Okay, got it.
Yep. Yeah, and I'm just looking at the futures, so I drew a big old box through that gap, and we are just now starting to come up towards it.
Right, it happened
Yeah.
in June. Just for people, if you want to go back to your charts and
Yeah.
refer it, it was between 10th and 13th of June.
Yep.
Yeah. So Arthur, what I'd say on a week over week basis, it's putting in a higher low, but a lower high. But then on a day over day basis, that's a lower low and a lower high. So that would be my takeaway: is that lower low and lower high is the first signal of a breakdown. You see that frequently. We called it out a couple weeks ago on XLP and XLU, and those started to break down. Same with XLV. So again, that's a really good sign when you're in your notebook, when you're starting to see those that lower low and lower high being put in. That's a really good indication, and especially something in a bearish trend. So if you've got a bearish trend and it puts in that lower low, that means the probability is increasing that it can go lower, right? So regardless of where that low is, it means it's increasing. As I said, I'm going to say it again because it's important. The probability is increasing that it can go lower, and so that's a telltale sign. So that, to me, that's whether you have a position in it or not. This is where that was circled and squared and starred in my notebook this morning, Arthur, because I've been chomping at the bit to try to put on a position again inside of inside of the Bitcoin crypto world. And going back to Hedgehogg's commentary about GDX and gold miners, if you get an explosion in VIX and a weakness in BTC, getting that juice on the crypto-related equities is going to be tasty.
Yeah, and if you look at it from a psychology perspective, if there are people who just threw their hands up when that flush happened and said, okay, I'm riding this out, you have to remember all those people are watching this big round number, 25,000. That was the last swing high we had. We're getting close to it. If we get up towards it, people will hold. Nobody sells all at once. But if it starts falling off of there, you could easily get a flood of people saying, this is my last best chance to get out. And that's where the selling will come from, is if it can't get up through that gap again. You have people just hanging, they're watching these charts, they're looking, am I going to get anywhere near my break even or anywhere near that last high? And if it starts falling off, that's where you can start getting the flood of sellers saying, oh, that was it, I'm out.
Yeah, thank you guys so much. That
Absolutely
clarifies a lot. Thank you very much.
Hey,
Yeah.
on that note too, on Bitcoin, the other thing too I've noticed probably about the last week or so, the volume's really kind of starting to fall off. Especially when we saw that big run up there. It's nowhere near what we were seeing during those weeks. And for me, the way I look at it, I mean, let's see, what is it? 22,590 is the number. I worry if it doesn't hold that, I think we're going to start to see the more weakness. I'm as upside down as Keith is on RTA because I was shorting it right there same time he was. I use Biddy. I don't short Bido. I just buy Biddy, and I just think you just need to hold on because with everything else, this thing's gonna go back down too. I don't know how far it'll go, but at the very least, I suspect I'll be able to get untrapped at some point in time. So
Andrew, just keep in mind that the inverse ETFs are promising you the return only for that session, especially inverse and the levered ETFs. And the way it works out, just from a percentage and math basis, is that when you have this kind of sideways or choppy market, the inverse ETFs tend to go down. And over a period of time, they actually don't give you the exact juice on the upside. when the actual fall starts happening. So this is true not just for BITI but also for SJB, which is the inverse for high yield, or any other similar ones such as
Yeah,
UVIX or some of the other ones.
PSQ. Yeah.
Yeah, they won't give you the exact juice that you would get. You'd get a somewhat of a lesser juice. You will get juice, but it won't be one for one. It would be, yeah,
Right.
it would be a
Yeah, I'm aware.
fraction for
Yep.
one.
Yep.
Andrew,
The
back
other
to you,
thing,
Leslie.
yeah, the other
Andrew's
thing
a
I was
seasoned vet
gonna,
with the inverses.
yeah, no,
Anyway, go
that's
ahead,
you.
Leslie.
That you're Bobby 3X, man.
Yeah,
That's
that's
all
true.
you.
I've never met a 3x inverse that I don't
Yeah,
like.
that you didn't like. As far as dollar, it's just kind of funny that the day everybody was freaking out was the day that we called it out that it had tagged tail. And what did it do the next day? It flew.
Freaking flew.
And the day after. So, for
Fly like an
anyone that's
eagle.
anybody that's freaking out that the process is broken or the math isn't working, all you need to do is see something tagging something that was advertised weeks before. I mean, that was several weeks before that we got that tail number. It tagged it and it just bounced like crazy. That's not broken. Um, the other thing I was going to bring up was for gold. So one of the things, and this is a very non-degen way to use options, but the way that you can capture upside and reduce your risk is how call options work. It gives you the positive convexity where if there were further upside, you capture it. If there is downside, you lose less and less against the premium that you've paid. Um, you just need to make sure to put them far enough out that you're not getting the theta burn. Pick a high enough delta to get, something like an 80 delta is nice. So you're getting 80 cents for every dollar of upside, and then not over levering your book. But to capture further upside while protecting yourself from the risk of, the whole market flushing gold with it, that's a really nice use for options, actually. And that's not a degen way. That's probably a more conventional way to use options. I'm sure Trent could jump in and fix
Yeah,
my
yeah, definitely.
but
So depending upon what your risk appetite is, and what you're targeting, that is one way. It's called as in the money options trade, what Leslie just described. Another mechanism is called verticals. So let's say, for example, if you think that um, gold is going to have a specific move, say from 175 to 180 in the next 3 months, and you want to capture that, then you could do a call vertical of 175 to 180, meaning you buy the 175, you sell the 180. Usually, when gold's at 175, this kind of call vertical would cost you like 2.5. And if by March, if in 3 months, not March, if in 3 months, if it actually goes above 180, you get the full five. Otherwise, you get the difference between where it's at and the 175 leg. So, long story short, there's multiple ways you could play it. Keep in mind the one I described has really low delta, which means that your 2.5 is going to become 2.6, not at the same pace at which GLD is moving. And your upside is capped, meaning in most you would make 5. But in percentage terms, it's 100% return. So depending upon how you size the position, how you look at it, etc., you can try it both ways, just on simulated accounts, just to get a hang or intuition of how things work out. And this is very important, right? While playing options, I'd highly recommend, uh, just from personal experience, to do it in simulated accounts until you get a hang of how theta burn works, how does wall crush work, how does there's a bunch of mechanics that work from a math sense as well as um, delta sense, what are the Greeks are within options, and then venture into it. Otherwise, just directly venturing in the main asset is fine too. Just keep tight stop losses, because what happens is sometimes folks don't understand the options and the Greeks, and eventually what may end up happening is your asset may end up moving in the direction that you envisioned, but your option may not give you that payoff. So get a hang of it in simulated accounts. Uh, if you have that hang, awesome. Then there's multiple ways to tackle it, but definitely what Leslie described, that you can have a defined risk, sort of an outcome using options, is very, very important, because then that way you can take advantage of the really high yield that you're getting by having a really low exposure through options for specific asset classes. So let's say if you define that you want to have 5% GLD exposure, alternative to that could be um, you could buy just 1% worth of options, be it call verticals or 80 delta or whatever. The remaining 4% you could keep it in Vanguard money market, earning yield, while you defined your risk at just 1% using the
Right.
option. So that's that.
Exactly. And that's exactly the point, is you're capping your risk at the 1%. If you have shares, you're participating in the downside 1-for-1. And
Exactly.
that's where options can really shine. There's actually some great videos, and it's specifically for gold, as an example, that Patrick Ceresna put out a couple of years ago. And he goes through the math of how to do share replacement. And if you just Google Patrick Ceresna on YouTube, I don't think he has all that many videos out there.
Oh, he's actually now associated with Macro Voices channel with Eric Townsend.
Right. Oh yeah, he's been a co-host for a while, but
Yeah.
he put these videos out. It's one of the things he does often in live seminars where he's part of it, is he kind of highlights the um, how you can use the convexity to your advantage. And it happens to be gold that he goes through the example with. So if anybody's interested in that, you just Google on YouTube. But it's just, it kind of brings up the, using puts and things to try to hedge your book has been really difficult for the past year. But this might be a case where just having call options instead of a share position, or, mix of both, might be a little more protective, give people some peace of mind.
And what
So
Leslie
I'm just
described is
sorry,
not an. Yeah, go ahead.
Trent, if I may, before we get too much deeper into this conversation, I just want everybody listening in that Trent and Leslie have spent years perfecting their options expertise and options, the way that they leverage it inside of their portfolio. So they are incredibly knowledgeable. But please, 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 please do not deploy this strategy unless you do a ton of research and understand your portfolio construction, your risk tolerance. This is all about risk management. So going back to the beginning of this call, and this is kind of when Trent jumped in, right? This is and love that Mount Mandelbrot, but you can sidestep its punches, right? We can sidestep their punches. I completely I agree with Leslie and Trent in terms of what they're talking about and expressing a gold position. I think it can be a great way, one way of deploying this process, but and taking advantage of what we see as a screamer inside of the gold space. But again, this is coming from two folks that are incredibly knowledgeable in the space. So please just keep that in mind.
Yeah, I actually wanted to highlight upon another aspect which is important, and this is now going slightly away from options. Right now, the yield available in the market from rates, so be it VMFXX, like I mentioned, I have VMFXX as the stable value fund in my 401k, but and it has been really instrumental, especially last year when everything went down so hard, and 401k is not offering you much options to. Um, because the alternatives which you have typically in 401ks are all long only, right? So how do you tackle that? You sidestep it. You just move your allocation to money market for that one really bad part which is coming up, and then uh, you know uh, you would have probably outperformed a whole lot of money managers out there. Um, and I was discussing about this with Brian once. So Brian actually told me an interesting feature that Fidelity has in something called as Fidelity Go. Brian, do you want to describe what you explained from asset allocation perspective, what we discussed last time, especially the linkage of that with the swap index part, that let's say if financial conditions are tight, what to do versus not. And I feel that that was an incredibly easy way to do asset allocation if you don't want to do too much active management. And I'll personally, kind of give it credence that in my 401k, I did something similar, but I didn't have just an easy switch like he described to me, that he witnessed in that Fidelity Go instrument or account. So, Brian, over to you.
Yeah, thanks, Trent. We were just sort of bantering back and forth on some
Asset
rates.
allocation.
Yeah, asset allocations, but it was based upon rate movement. And so Trent was saying, well, risk on versus risk off, essentially. How can you do it easier? And I just mentioned that I don't use it. It's not advice, but I literally don't use it. It's just a feature that Fidelity has. It's called Fidelity Go, and they've got 5 or 6 different options, all the way from least aggressive to most aggressive. And you literally can just tap a button and then hit go, and it will essentially do 80-20 either direction or 50-50 in the middle. And it's a little easier way, I think, if you want to go risk off versus risk off. I think that's your point, Trend.
Yeah. So when Brian says 80-20, that's 80 stocks, 20 bonds versus 20 stocks, 80 bonds. And this is obviously, you're trying to outperform the VBINX portfolio. So VBINX stands for the Vanguard Fund, which is famous for its multi-asset portfolio. It has a little bit of everything, kind of tries to replicate 60-40, but yeah, that's what I was trying to say, Brian. I know last year 60-40 also underperformed, but nonetheless, I felt that kind of switching in asset allocation was pretty straightforward and easy, especially for folks who don't want to do active management, right? Like I've come across folks who, amongst my friends and acquaintances, who asked me that, hey, I just want to preserve this. I don't want to have a drawdown. So the yields right now in the market are really, really attractive. I mean, think about it, right? You're getting 1-year CDs at, I think the last I saw was 4.75, and Brian is probably more up to date with that than me, but I think it was 4.75, the last one I saw from Truist Bank in terms of CDs.
Yeah, yeah, Brian. I was just going to say, why don't we just you shared a couple thoughts on munis earlier. Why don't we? It's a good pivot, right, in terms of that portion of the fixed income space. And I know you're always so kind to share what you're seeing in regards to the muni world and that kind of thing. So yeah, the floor is yours, my man.
Sure.
And thank you for joining.
Appreciate it. Haven't been on a little while, but the anxiety meter, when it goes up, I start getting pinged more on muni bonds. So I thought I would just share a few things that I'm seeing. Nothing is advice, of course, just observations. First of all, I wasn't planning on discussing this, but I watch a rate called SIFMA. SIFMA is a tax-exempt weekly rate. The reason that it's important is that your leveraged funds, they have a tender option bond piece that's kind of like off to the right that provides leverage. They will buy 5%, 4% coupon municipal bonds, and then they'll have the variable rate, which is SIFMA, and they'll have a spread. So last week, SIFMA was a 187. So if you had a 4% bond, you're running a little more than 200 basis points positive spread. I was pretty shocked today when I hit refresh. SIFMA reset to a 374, so it doubled in 7 days. And we were at a 386 in December, and I was talking about the fund JMST that buys some of this weekly rate paper. When you think about it, a 3.74, if you divide it by 1 minus 37%, so 0.63, it's a taxable equivalent yield of a 594. And that's the tax exempt. Now you compare that to SOFR, which is your secured overnight financing rate, and SOFR is taxable at a 455, which means SIFMA is 82% of SOFR. We saw last year it was in the 50% range. It was too low, and then they kind of had a reset. And then we reached to the end of the year where a lot of folks don't park funds in weekly rate. But what's happening is we're seeing competition. So SMA accounts and corporate accounts are shopping the rate between taxable and tax exempt. And I'm trying to figure out, and Trent and I were discussing it this weekend, is SIFMA, because it's a weekly rate, is it another data point that we can look at from a short-term basis to determine kind of, cash flow situation and what's coming into the market and what's coming out of the market. So I wasn't planning on talking about SIFMA today, but a very unusual move. I'll call JP Morgan tomorrow and see what their desk is saying. But if you're in leveraged bond funds, I would be keeping an eye on short-term rates and whether or not a squeeze is slowly grinding towards you. What I did want to talk about is muni rates. So I get a lot of questions about favorite funds and things like that. I'm not a big fund fan. I'm a credit fan. My favorite credit fund is MMIN. It is a fund that only invests in insured municipal bonds. And because they're insured, that means somebody in the insurance side did all the due diligence and they pretty much only insure essential service. So there was a clickbait article, B of A says municipal defaults are on the rise and used 165% number. That was pretty much limited to nursing homes and hospitals, which are not essential service. Essential service is going to be school, water, sewer, things like that. The fund has no leverage in it. And the reason that I like to monitor it is it gives me an idea of net asset value and whether or not munis are selling off or whether they're taking in money. So I put up a tweet today that had 3 attachments to it, and then I did a reply to it with a couple more. And so I looked at MMIN, and I identified that on October 28th was the low point for MMIN, which means that would be sort of the highest yield, lowest price from the last year.
And sorry, Brian, just for those listening in, I did put that in the nest. So just as Brian's going through that, you can, if you just kind of pull up slightly on the speakers, you can see that's the second tweet. So I attached that to the nest.
Okay. So the first one is just the data point of October 28th is a date in which we saw kind of highs in yields. The second is I pulled MMD. So MMD is what we use to price municipal bonds in the primary market off of. It's published every day, and the yields that's listed is for a AAA rated entity with a 5% coupon callable in 10 years. And I put all the columns are labeled A through J, but I put where MMD was on January 3rd, the first trading day of the year, and then I put where it is today. And you can see that we have had a rally in rates. So just looking at the 10-year rate, 2033 maturity, we were at a 264 January 3rd, and now we're at a 223. The thing about the 223 is when you're talking munis, you have to convert that to a tax exempt rate. So it's called your taxable equivalent. And so if you take the 223 and you times it by 1 minus your tax bracket, usually you just use the highest tax bracket, which is 37%, so 0.63. So 2.23% divided by 0.63 will equal 3.54%. So you would compare the 354 to say a CD and decide whether or not this is a good investment or not. I then went back all the way to October and pulled the MMD from that time period. And in the 2033 10-year space, you're looking at, we were at a 341, which is a change of 118 basis points or 34.6%. That is a monster move in yields for the muni space. And I went through all my trades. I've been pretty public on how aggressive I was buying munis, individual munis, in the Q3, Q4 of last year. And I actually bought a Scott County school bond, Kentucky school bond, 2045, 23-year bond, 4s to yield a 4.903. And the taxable equivalent yield of that is a 7.783%. Now, I live in Kentucky, and so I have a state tax. So it would actually be higher because we have to pay state taxes. If you're in a state that doesn't have a state tax, then you really can kind of shop, around the country in terms of your options. So that just gives you some data points in terms of where we were, where we started the year at, and really where we are today. And there are more cuts today on MMD, so rates on the short end are going up a little bit. And then lastly on this topic...
You shared a tweet too, Brian, about if you go local munis as well, you can get kind of like an additional tax benefit. So I actually didn't realize that. So for those, go look at Brian's kind of some of his tweet replies today. He briefly touched base on that. So just wanted to mention that too.
Yeah, and so that brings me to my third one, which is we sold on, what's the date today? Today's Wednesday. So we actually sold yesterday a hometown issue, Fayette County Schools, AA rated. It sold yesterday. It was $37.5 million. And I put up as the third attachment, the coupons and the yields from the transaction. And I put in a red bracket the spread, so you can see where the MMD was in the spread from AAA that these bonds came at. And then I calculated for each of the maturities what's the tax equivalent yield. So people will send me a message and say, hey, what's a good bond to buy or what's a good rate? And what you want to do is look in the primary market. So I bird dogged just the longest rate, which is 2048 maturity. And so if it's yielding a 4.1 and you divide it by 1 minus 37%, which is 0.63, you get a taxable equivalent yield of a 651. Now, that does not include any benefit that you would get if you're a Kentucky resident, which I would get a 4.5% benefit. And then locally, if you live in Fayette County, Kentucky, which I do, you would get the local tax benefit. That would make it what we call a triple tax-free bond. So you have single tax-free, double, and triple. Now, this bond, the reason I put it up is I actually can't buy it because my firm is a financial advisor on it. So I put it up. It's not a recommendation. It's obviously a high-quality piece of paper, but it gives you a roadmap as to where rates are, how they spread to that MMD AAA scale, and then how to compute the taxable equivalent yield. And then the last thing I want to touch on is I took the same bond because I got a message, and a bond is nothing more than a cash flow stream. And you really have to understand that that's all it is. And so I replied to my tweet and I put, if you were to buy that 2048 maturity, what is your return? And the bond would close on December 28th. And that's on the spreadsheet I put up. And then every 9/1 and 3/1, you'd be getting an interest payment of roughly $500 or $1,000 a year if you invested $25,000. But you didn't pay $25,000 for it because the price is 98.444%. So you would pay $24,611, but you would get $25,000 at maturity, or if it was called early, they can prepay it at the 10-year mark. And it shows you how to calculate what your interest stream is. And at the bottom in Excel, you can do XIRR, the formula, and it will compute for you your internal rate of return. And I computed it two ways. So because you're buying it at a discount, the 410 actually ends up being a 414. internal rate of return. But then if it goes to the call date, right? So if you buy a 20 plus year bond, but you get paid off in 10 years instead of maturity, that discount, you get paid that back, that little extra bump. And so your IRR, your internal return, is 4.25. And so the point is if you want to play in the muni bond space and you want to buy individual bonds, just like we hear on the macro show or in any research that you do about doing the work, you got to do the work, you got to do the work. It's the same thing with these bonds. You have to put the time to understand the cash flow stream because that's really what you're buying. If you're buying TLT, if you're buying EDV, that's different. Those aren't necessarily a cash flow stream. Those can be a trade. Those can be a hedge. But these are buying, individual municipal bonds where they're not really an item that you're trying to buy and sell. You're really holding it. And that's really it. The only other comment I have for you, Robert, on the decision front is in my career, I had a boss that gave me a lot of good lessons. And one of his sayings was, not making a decision is making a decision.
Absolutely. Absolutely. A great rundown, Brian. I appreciate you taking the time to do that for many here within Hedgeye Nation. It's, muni bonds have obviously become a much more interested, portion of the asset allocation, and rightfully so. And you're an absolute pro and expert on it. So I'm very grateful for you sharing your wisdom and knowledge. And thanks to your wife for not being around tonight, so that you can jump on.
Yeah, no problem. And if anyone has any questions, feel free to just send me a message. And I speak to a lot of people on the phone and enjoy speaking to people on the phone about how the municipal bonds work. And then, my wife, just anyone long Disney, you can thank my wife. They reported earnings. And my wife crushed it. My wife, her gift card purchases must have worked. It's up like, I don't know, last I looked, 10% or something. It's crazy.
Yeah, a little restructuring happening and all sorts of fun stuff there. Right? Parks are still killing it. But yeah, no, it's anyway, the Freebird will have that update on the morning call tomorrow. But
good deal.
I get the pleasure of seeing him here in the office, and he gave me the quick rundown before I jumped on, so it's always fun. Tom and Eric, Tom, you jumped on, and Eric Carlisle. Why don't we go to Tom first, and Eric will come to you, buddy.
Okay, yeah, I started. Thanks,
Yeah, of course,
Robert, for letting me talk. And I always appreciate you guys are all so knowledgeable. I've been doing this a long time, but it's more of a hobby with me. I have a full-time job, and I try to keep up with the markets as best I can. And Hedgeye does help with that quite a bit. I had a couple questions and maybe just some comments to share about some of the things that you other guys have said that I might be able to add just a little bit of value with. First of all, on the options, I think, Trent, I don't think you said this, but I think another benefit of the spreads that you were talking about is the theta burn.
Robert, you want me to go?
I'm sorry?
Sorry, Tom. Eric, can you just hold on a second, buddy? Tom. Yeah,
Sure.
thanks, man.
Yeah. So I think with
spreads.
the spreads that Trent was talking about, you also mitigate the theta burn because the short and the long kind of balances that out, is my understanding. So I think that's a nice thing to do. I don't do options a lot. I did get into it many years ago. For those wanting to explore it more, besides what Leslie had mentioned, there's Options Alpha. I think all their training on the site is free if you look up optionsalpha.com. And they also have a paid service where you can kind of follow along the owner of it. I forget the guy's name, but he's very good, very responsive, and
That's Kirk.
Kirk, yes, thank you,
Yeah,
Leslie.
it's optionalpha.com. Do they still have the service?
I don't know. I haven't looked at it in a long time.
It's been years, but that is where I started learning options. He did an amazing job. They've created a bot trading platform that's what you'll find if you go to the optionalpha.com landing page. But the videos are still in there. It's under university or legacy or something like that. I haven't looked in a while, but yeah, it's there.
Yeah, last time I was engaged with them, they were just starting a deal with TD Ameritrade and Thinkorswim to do their bot thing, and You could buy into it. I didn't buy into it for a lifetime service or anything like that, but it sounded very interesting. I should check back with them and see
Yeah,
how that's coming along.
it's up. There's a bunch of people running on it. I have not had the time to dig into it. I do have access, and it's just on the list.
Yeah. Yeah, so that's also Thinkorswim. Trent mentioned doing paper trading. Thinkorswim is an excellent paper trading thing. And when I was doing options alpha at the time, he was really um, advocating for selling, the credit spreads and things like that for selling volatility, and that worked great. I paper traded it for like I think 2 months on Thinkorswim, and the problem with paper trading is you got to really work hard to take it serious, pretend it's real money that you're working with. And until I started getting profitable fairly consistently, I didn't start using real money. And then after that, I did okay with it. I'd find with credit spreads, you'd make a little money 5 trades in a row, and then you'd lose it pretty big. When it goes bad pretty good. At least that was my experience. So you got to kind of be careful there and manage risk. And Kirk does take you through all that stuff in his training, so I would highly recommend that. Regarding CDs, I forget who brought it up. If you remember, I don't know, it's many weeks ago, probably several months ago. In this forum, I mentioned I was looking at CDs to put some cash to work while we're waiting for the storm clouds to pass. And I did do that a little bit, and then somebody in this forum suggested that I look at short-term treasuries instead, which I did, and it is a much better way to go. One, they're more marketable if you need to sell them early. Two, the interest is not taxable in your state, so that you get free interest there is from a state income tax perspective, and what else I was going to say? They're marketable. And I've been doing short-term ones. I lettered it out like 3, 6, 12 months is where I'm at now. And that way, every 3 months, you have part of your money coming back and you decide to put it in the market or, roll it out to the next year. So you have that ladder rolling along. The last couple I did were like 4.5% for 6 months or maybe a year out. So that's, I'm very happy with that. It's not beating inflation, but it's also not much at risk either. So at least you're getting something back. There's that. Options. I've also been talking about the leveraged ETFs, like the PSQ isn't leverage, it's inverse, but like the QIDs and the QLDs and things like that. So because they're nice for short term, and I do use them for that. I don't go to the 3x, I'll go out to the 2x. Another thing I've been exploring and I'm very interested in is futures for that. You can get some pretty good leverage. I find futures, they're a little more complicated than stocks and ETFs. They're not, in my mind, quite as complicated as options. You do really got to understand the multipliers and the minimum amount that you have to put in and how that can work against you if your position is going against you. But that's a great thing to explore, I think. And the other nice thing I like about it is that most of them, at least the ones I've been using, are open pretty much 24 hours a day during the week. And in Thinkorswim anyway, you can have stop losses and trailing stop losses and get alerts on those things throughout the night, so that you don't wake up with a big drop, a big surprise in the morning. You might have a little surprise, but you won't have a big surprise if you have your stops on or your trailing stops. So that can be a benefit. That's something that I really appreciate. So that's something people might want to explore. And then the next thing I have is just a couple of questions. Sorry, I'm going on so long. Hopefully this is interesting.
It is, Tom. Sorry. Yeah, no, it is. It is. You're doing a good job.
Okay, thanks.
Keep rolling. Keep rolling.
So my one question is, I hear on Hedgeye people talk about the trend line. We're going to break it or fall against it. The products I subscribe to are things like ETF Pro and Investing Ideas and Risk Ranges, where you get the ranges, but I don't think I've ever seen anywhere where the trend lines are published. Is that something that comes with Macro Pro, or is there someplace else I should be looking for that information?
No, not the trends. Those are often mentioned on the macro show or in an early look like that. They are some of those trend lines are published inside of the macro themes deck.
Okay.
So that's something new that we started in with Q1. So for instance, sorry, I'm just pulling up the deck now. Some of the longs that we like some of the China exposures, precious metal exposures. Those trend
Okay.
lines those trend levels are provided for a few things like FXE, WH, KWeb, that kind of like just in terms of like the China exposures. So
Okay.
those are provided in the macro themes mid quarter update that we had yesterday. So that is so those are there. But in terms of like an ongoing regular basis, those trend lines aren't mentioned and typically will be done so when Keith, when it kind of comes into his overall review and analysis and they, it becomes kind of worthy of mentioning type thing, right, Tom?
Okay. Yeah,
Yeah,
that's what I thought. I thought it's his proprietary algorithms that calculate that stuff out. He's not like looking back 3 months and picking a particular point on his
that's
chart.
correct.
He's
That's
okay.
correct.
That's what I
Yeah,
thought.
yeah,
Okay.
yeah, yeah, yeah. So that's correct.
Okay, cool. So I'm not missing anything that I
No,
should be getting as far as I can tell.
no,
So
yep.
thanks for that. And then my last thing is, and this might be a little bit longer discussion than you guys want, or you guys probably already know this, but there's been a lot of talk of the zero DTEs. My understanding is that some people are buying lottery. The buyers are buying lottery tickets, hoping that they spend a nickel on an option and they cash in for dollars, and then so that's the buyer's motivation. I don't necessarily buy into it, and then the seller's motivation is, well, if I can pick up these nickels for free, why not? So that's what I think my understanding, or that's what my understanding is. I'm not sure how right it is, but my part that I'm hoping to maybe you guys can help explain a little bit is how are these things moving the market so much? If you've got two sides of a trade going on, the buyers and the sellers of these options, how is that affecting the broader market or the broader market for those particular underlines that those options are going against? Could anybody
So,
explain?
Tom, there's a lot of misconception about zero DT. So I'll go step by step, right? So first one, you mentioned that the buyer has a lottery buying kind of disposition. True for mostly retail sort of crowd, but that's a very small subsegment at about 6 to 7% of the volume. The majority of volume is from high frequency firms. These are high frequency firms who, for the past decade, had mastered the art of understanding what the MOC auction would be. So, MOC is market on close, and
Okay.
market on close is a very big, knowledge base by itself. You can research about it and find out uh, basically in the last 10 minutes, funds who want to have no basis related problems at the close, they end up coming there and saying, okay, we tried buying X number of shares during the day, but we want to buy the remainder right now. And this is the price which we are willing to buy. And it's an auction process. So, the prices keep changing within that 10-minute period. Usually they're not a huge swing, but typically you'll at 3:50 p.m. Eastern you'll see some sort of minor volatility that gets embedded if the expected MOC imbalance number is different than what these HFT firms expected. So there are multiple firms who used to compete in this, and the margin on it is very thin, but they apply so much leverage on it that it's absolutely worth doing it. And I'm right now not describing zero DTM. I'm describing the uh, guessing where the buy order is and trying to front run it just by sensing using the order books. Okay, so these firms
Okay.
are basically running machine learning, deep learning sort of algorithms on the order books because they have direct market access, and you can find a ton of scores of papers on this in Google Scholar on how to do machine learning on order book, be it for options or be it for any given market, be it commodities market, be it ETF market, be it the US equities, European equities, doesn't matter. You'll find a bunch of research papers on this. So the HFT firms have their own proprietary mechanisms of finding out where that small juice is by which they can keep making money. Now, who all are the participants in this? So other than the three firms that Keith keeps naming, like Siskiyana, Citadel, or Millennium, there's actually other players in it as well. So, for example, Goldman has one desk which does that. They also provide tools to their institutional clients who want to do this. So if you go to their website, just by searching Goldman Sachs AWS, they tout about providing these kind of ammunition or tools with Python notebooks and other things for the institutional clients to do their own analysis and execute on this. Now, since that business was getting crowded due to easily available ammunition and arms, it became like an arms race, right? People started posting their servers right next to the exchange server in New Jersey. And they also started competing on the fiber length and whatnot. And you'll find a whole bunch of information about this on the web as well as on YouTube if you want to go through that exercise. Now, those HFT firms, whoever survived, there's a bunch of other ones such as TradeWorks is there and a few others are there um, who not only survived but thrived, and they went to the further extent of trying to find all these event-driven alphas. So they tried finding event-driven alpha and, hey, which will be the next stock that will be included in the index, and how can we form a trade around that? And it's a probabilistic game, right? They don't know exactly which stock is going to be included. They know 10 stocks, which are a high probability, of which 3 or 5 or 7 would be included. And then they try to guess on the other side a basket which will be excluded, and then they try to trade around that. Why am I sharing all this? Is because the same set of people became the institutional people who jumped in order to have this zero DT options action. On the seller side, it's not collecting nickels in front of steamroller. The sellers actually hedge it out on the other side by delta hedging. There are specialized delta hedging desks. What they would do is they would say, okay, I'll make the market, I'll give you the bid and the ask. Right at 10 a.m., the bid and the ask is kind of wide for this kind of instrument, which is fairly liquid, in which they can easily hedge it out at not much of a cost, but they'll still keep it wide. And then they would provide that liquidity. So that's the liquidity providers. They're making a bank on this at above the cost of capital for them. And the buyers are buying it while doing all this estimation through all the order books of all the constituents of S&P 500. And because they had specialized this, or they had mastered this art of where the MOC imbalance is going to be there, they can utilize the same asset base or same knowledge base in order to gauge where the SPX is going to close. So as soon as this product came out, the SPX 0DTE, it was amazing. They could leverage their existing knowledge base and their tools and ammunition in order to take advantage of the SPX 0DTE. So it's not some retail trying to buy a lotto in order to make money, or it's not any manipulation. Of course, there's some sort of reflexivity that happens. So within that 15, 20 minutes, in the last, in the end 20 minutes, you'll see that there's some sort of volatility that happens. But all this notion about zero DT volume causing some sort of manipulation intraday is all humbug. Okay, these are nothing but HFT firms who are doing MOC imbalance related trades in the past. Probabilistic trade, they are not 100% certain, meaning there's no guarantee that they'll make money every day. And they flatten out every day, meaning they do not carry over these positions over multiple sessions. So anyone telling you that, hey, zero DT is causing this upward trajectory in S&P 500 just does not understand what that whole mechanism is, who the players are in it. It does influence the price of the underlying of S&P 500 for that day, but only up until 4 p.m. At 4 p.m., everything is squared out. These players are flat, the buyers. The sellers are delta hedged, right? So there's no manipulation going on. This is just people who used to front run large institutional orders, and I shouldn't say the word front run, they used to estimate the large institutional orders through their science and statistics and other mechanisms, are now capable of taking advantage of this derivative product, and that's what they're doing. So I hope this helps, because there's a lot of misinformation about this, especially by people who don't understand the space well. So just wanted to share that information out there. And
Yeah,
there's an interesting article on this on Zero Hedge about it as well. You can refer to that, but it's hard to put two and two together until you get this background about it.
Yeah, excellent, excellent, Trent. That's very, very
Yeah, and
helpful.
Tom, what else add to that is, the liquidity is a big piece, right? So if the volume and liquidity isn't there, market depth isn't there, which it hasn't been for for the last for a while, to be honest, but particularly this year, and then the high frequency traders figuring this piece out, it doesn't quite work as well, and likely where zero DTE like volume has increased really ever since kind of for the last, call it 2 years, ever since kind of 21. And there's a slide 30 in the macro themes deck from yesterday that highlights the increase in call volume, US total option call volume, going back to February 2000, so the last 23 years. But so again, what I'll echo, and Trends summarized it very well there. But again, volume is a big piece here, and as if volume comes in, it doesn't quite get pinned in the same manner as you saw yesterday. Got pinned to 415 because there was a bunch of volume on the 415 calls, and then today at the puts were at 410. 481,000 contracts, I believe, that from a volume standpoint that traded at 410 today. So again, this mechanism, but volume was relatively light in terms of across many assets or many pieces of inventory. If you kind of look at the volume today versus yesterday, where the volume was quite high, right? It was 26% higher on a day-over-day basis, 17% on a 1 month average. So we did see volume come in yesterday, but I suspect certainly on a day-over-day basis, and what I was seeing on the board is that volume is going to be weaker on a day-over-day and that kind of thing. So just keep that in mind as well.
Okay, yeah, thank you. That's very helpful.
Yeah, awesome. All right, well, let's so Eric, he was up next, and then I'll come to Andrew and Alan as well. You guys got your hands raised, but Eric, welcome to Weekly Notebook Review.
Yeah, no. First off, Trent, that was a perfect summary of ODT, and I really appreciate you dispelling a lot of myths that exist out there for it. I do disagree that people are zeroing out their full exposures. If only you look at the traded volumes on the next day DTE, you'll see that they're not necessarily fully zeroing out their exposures associated with it.
Right, and that's a different strategy. So what you're
I'm
describing
just
is
saying,
somebody.
again, I'm just saying that that's exactly. It's not always true that they are completely zeroing out. I know this from some of the people who are actually doing this. The second thing is, the reason why this is suppressing volume so much is because the institutions now have a new way of getting on exposure versus an S&P exposure, or a regular S&P exposure, with less slippage. And that means that individual...
You mean suppressing volume or suppressing volatility?
Volatility.
Okay, yeah, you said volume. Okay, understood.
Yeah. Against it. And so institutions are using this in order to suppress volatility, to be able to put on, if I'm a Vanguard and I have to put on, $9 million worth of, or $50 million worth of S&P exposure, I can use these options as a way to suppress the slippage that I would get if I went into the individual stock transactions. And it's just happening, and we all need to understand that.
So I did speak with Vanguard folks, and they don't use 0DT at all, or 1DT.
No, they don't, but they're taking advantage of it, is what I'm saying.
No, they just stand, Eric, at the end of the day as MOC, MOC volume on the other side of the auction. And these HFT firms just supply them with what they need based upon their estimates of what they're going to need. So there's, let's say, 5 different participants, right? So TradeWorks, SSGA, I mean, Susquehanna, or a bunch of others. They'll just accumulate whatever they estimated that Vanguard is going to need. They'll give it to Vanguard on the MOC auction, and then rest they'll flatten out at whatever cost. So they don't actually carry forward. That's the business model for HFT. They do not carry forward market risk to the next day.
Finally, Robert, I have 3 other things here. Number one is XLC versus telecom. You never got me back an answer in terms of whether we're using the XLC or the 2-digit GICs. This is holding up my research, and I really need to understand that.
Yeah, so I did reach out, and I'm still trying to get an answer for you, Eric. So it's not that you're, but I would go off of telecom for right now.
You would go with telecom. It's the 2-digit GICs as opposed to the XLC.
Yes.
Okay.
Yes.
Then the single-digit GICs.
Correct.
Okay. Yep. Interesting to me today that KWeb was not added in Macro Pro after Keith talked a whole lot about it in the macro show this morning. That he was holding off on adding any new because of the envelope risk around the State of the Union, and then he didn't add any. And I'm just wondering if anybody had any insights regarding KWeb on that. And finally, the last observation that I wanted to make was we have been in the chop bucket for 109 days. I don't know how many trading days, but 109 days in the VIX, with the market from 3,700 up to 4,100, which is more than almost 11% change. Is the chop bucket the new investable bucket? And those are just questions that I wanted to throw out there.
I mean, I can take a stab at the chop bucket as investable bucket piece. I would reconcile that, or I would rephrase that as, if one has extremely tight risk management, then most likely at about Jan 9th or Jan 10th, you'd have gotten signals within your portfolio or whatever that however your position was probably not long enough and that you had to go long. Meaning, I personally got a ton of signals that I need more long beta on my portfolio. And that's around the time when I started sharing on the spaces that, hey, I'm cutting my European shorts as soon as they hit my stop losses or whatever. And I did cut them. At the same time, I did go long slowly, steadily between 10th and 26th of January. And on 26th, I think I shared the relative rotation graph of what's right now doing really well versus not. There are 2 alternatives always, right? So one could just be in cash and not let this counter trend sort of rally bother you. But if you're active, if you're long short, then one should definitely have extremely stringent risk management in place. So the reason why firms like Citadel or Millennium multi-strat funds made so much returns last year is primarily because they have extremely tight risk management for their PMs, to a degree where PMs sometimes don't want to work for these firms because you don't get, one, you may not get adequate capital, or 2, you might just be super on the edge to constantly keep going in the direction of where the market is going. So I know Keith likes to say that the performance chasing PMs, but that's how their risk management works. So if on 9 Jan or 10 Jan, if they got a tap on their shoulder from the risk management that, hey, you are too short, then they immediately turn around and go long because they have those constraints. If they were down 5 to 7%, they're out. Their capital line collapses, the entire portfolio is busted, and they're gone. So if for personal reasons, if one is running a long short, one should have similar sort of risk management in place. One cannot have longs returning 3% while your shorts are up 30%. That's not prudent risk management at all. The second part I would say is that the entire TGA piece, right, the Treasury General Account piece, has been going on since December. So I know that in the mid-quarter update we had a mention of that, which is great. But that whole mechanism by which certain liquidity is injected in the market, causing this kind of an upward pressure, especially in risk assets and financial conditions easing, is going to stay here till the debt ceiling is resolved, right? So the catalysts on the downside are either debt ceiling gets resolved in next few weeks to a few months, or we get some sort of geopolitical conflict, or we just have a huge credit event with one of the major S&P 500 companies, resulting into some sort of cascade. So, one should try to game theory out some of these catalysts and be on the lookout for that sort of a piece. But otherwise, yeah, this is an investing market where one definitely needs to lean on the long side. If one is not leaning on the long side, then the underperformance is significant, because year to date S&P 500 is up 7%, 7% or something, and from the period where you mentioned, it's up 11% or 12%. Nasdaq is up even more. Nasdaq is up year to date 15. So depending upon what your benchmark is, one would want to make sure that the exposure beta wise is in that form. And yes, this is an investing regime or investable regime at the moment, not for a long term allocation. It needs to be actively managed. So I hope that helps. That's my view on the current setup. I don't know if it answered your question. Again, anything I'm saying is not not an advice. It's just my opinion. So back to you, Eric.
No, I appreciate it, Trent, and it makes a whole lot of sense. I just the long have had horrible alpha days. Last Thursday and last Tuesday that Keith is highlighting here, and I just wish that he would add some more beta into the long portfolios if we see this set of events. And and I can go through the signals that I have here and add those in, and I think it would cause a whole lot less pain for some of the people.
Right, but Eric, that's where I think Rob also emphasizes this, and I think Keith also talks about it on the show, that whatever he's saying is not a portfolio, right? So I usually take all the inputs as an augmentation to my process. Like, I try to keep my process as my process because I'm the steward of my capital, right? Tomorrow, if my PNL is down 15% compared to the market, I mean, relative to the market, it's just me, because I can't rely on just one research house for all my sourcing of ideas, right? I just have a huge playbook of strategies. Like if you're playing football, you cannot have one strategy and expect to win the football game, right? Typically, a coach tends to have like 10, 20, 30, 40, 50 strategies. So similarly in investment, I mean, I believe that different regimes of liquidity, of volatility, of there's many factors in which you can qualify a market regime. Different regimes require different kind of strategies. So the moment you see a regime coming into play, then you have to deploy those strategies in place in order to take advantage of that. So Dalio had a quote on this. I forgot the exact quote, but it had something to do about similar aspect, that depending upon your regime, you have to put your strategy in place and see how it works out. So I think characterizing the alerts or anything coming out of the research house as portfolio wouldn't be a great idea. I mean, I just use it for augmentation as an input source, as one of the signals. There are multiple signals that go into the portfolio. Some of them are my homegrown data pipeline signals. Some of them are from other sources. The bottom line is that I consider myself as meaning the buck stops with me, right? Like I consider myself as the ultimate steward of the capital, and I'm the investment committee of one for my portfolio, and I have to make sure that I'm prudent at that. That's all I have to add. Rob, back to
Yeah,
you.
it's a heck of a committee you got there, Trent. I'm not going to lie. But yeah, and Eric, just in terms of the China thing, 3 out of the top 10 in his long only in his MoFo account is China exposure, and one could say that New Zealand would be a fourth, so 4 out of the top 10. So again, I mean, it could just be a sizing thing that he's got on, Eric, in regards to wishing to get more exposure. The SEC, the China, in terms of the risk range, it did put in a lower high, but a higher low. So there is some consolidation there. So he might just be waiting for a little bit of confirmation from the Shanghai index there. But again, with that said as well, though, he did add a China exposure to ETF Pro around 3-ish today. So that could be another. That's another way to communicate that adding additional Chinese exposure post the update via re-rank. Right. So there's that piece too. But I don't really have a good answer. I don't. He definitely talked about it. I think this is piggybacking off a trend. Depending on your sizing of KWeb, if you needed to gross back up, it was down near the low end of the risk range, and is potentially it appears as it would be a good place to do that. So again, kind of one of these things where it all depends on your current portfolio construction, position sizing. Again, I know you know all this, Eric, but just reiterating it for everyone else out there that there's you got to use all the pieces of the puzzle, right? So, hope that.
Also, one important aspect I would add is the importance of some sort of stop loss to define the risk, because like one cannot have a short position go like 30, 40, 50% going against you. So definitely having or even long position for that matter, doesn't matter
Yeah,
which side it
yeah,
is, right? Long or short. One has to exercise prudent risk management. Also, again, it depends on the time horizon too, right? Like for example, when March 2020 happened, Munger bought into one of the pharma firms. I'm trying to remember which one. AbbVie, yeah, AbbVie. It went. I think he bought it at like 95 or 100 or something, 120. It went all the way down to 80, and he bought some more, right? So he probably, his pieces he wanted to collect for sizing his AbbVie position was spread out over such a wide set of strikes, right? Like 120, 180, whatever. And then eventually it turned around and gave him whatever he needed. He obviously needed liquidity, he needed size of the company, and he had willingness for another 50% drawdown if that were to happen. And it did happen with him in case of Alibaba, right? So different investment style. And if one is looking for something like that, then there are many opportunities, especially in the if you go down like the micro cap or the small cap list. There's so many companies out there which were like that in late last year. But the reason I'm sharing that is because I personally don't keep something which would have that kind of a huge drawdown if it's at full position size, meaning at around 4% or 5% or whatever it is. But for somebody else, they might want to carry it. They might want to carry it until it becomes half and then wait for it to become 5 times after that. Depends on their thesis, depends on their conviction, depends on their portfolio construction focus, and also depends on their level of activity. Some folks are passive. They're buying a business, right? They buy a business, sit on it for 5-10 years, and then exit out after that. And that's perfectly fine too. So again, whatever suits one's philosophy on investment, or the suitability aspect is very individual and personal.
Yeah, and we've talked about it, Trent, a couple of times in terms of just from a pure math standpoint. Once you go beyond 12%, you need more and more up, basically return or upside in order to get to break even. So that math is very readily available. Again, 12% is kind of that number where if you're down 12, kind of got to be up 12. But once you get to 13, it just gets harder and harder. You just need more and more of a move. Not necessarily harder, but just more and more of a move. Awesome. Well, we're coming up on the hour. So, Alan, why don't we get your hand raised? Welcome back, my friend. And
Thank
go
you
to you.
so
Yeah.
much. Thank you so much for taking my question. Again, I think the question will imply that I'm new. But I just kind of want to, I the way I see it is when you say things like volatility suppression, to me it's just noise. Because the way I see it is like, when it comes to these bear market rallies, obviously it's important to pay attention to risk ranges in terms of the assets that we want. And of course, it's a long short book for a reason because you really can't do all in or all out of one or the other. So my real question is how do you kind of, I guess, risk manage, certain longs, like, there's all kinds of strategies like inverse ETFs and stuff like that, without necessarily thinking, hey, I'm going long, not just because it's at the low end of the range, but also everyone else is FOMOing. So, like, let's just go with that. Because to me, when I hear volatility suppress, it just kind of sounds like a lazy way for everyone to just kind of make money because everyone knows reality, right? But obviously, when you see things that are high short interest that are just making new highs, obviously when it comes to risk management, you really have to like wait and watch. And I suppose when you see, you know, one side of your book kind of making these gains, when you prune and then try and replant, in terms of certain shorts, sometimes they don't always get into, ideal positions in terms of top end of the range or low end of the range. So I guess my question is how do you kind of contextualize, bear market rallies in terms of like, hey, it's okay if you, you know, miss out on certain opportunities or, I guess there's a lot of anxiety when it comes to going either way. Um, and I guess, my main concern is, because of reality, economic reality, it's very intriguing to go long certain things. Um, I think the answer to my question is just the process. Just fuck the noise. Just low end of the range, top end of the range. That's kind of what I look at, and that has saved me so many times from making a really bad mistake. But when it comes to days like today, where shorts are up, it's just uh, trying to replant is a little bit of my challenge, because we're so focused on, like, I guess just not losing, where I don't I guess I FOMO on my own gains because I think, man, like, had I X, then would have made more. If that kind of makes sense.
Yeah.
I suppose, how do you kind of fade the noise, and in terms of like, hey, everyone's with these options and stuff like that, how do you kind of fade those kinds of things? And I stick to ETFs because they're less volatile, but and also I think he kind of answered some of that question because he was saying, a lot of these things have to be very actively managed, and so it's really about the time you dedicate to these kinds of things. And obviously, I want to imply that I am new because people have jobs and shit, you feel me,
Mm-hmm.
like uh, like, does that make sense?
Yeah.
Like, I'm I'm actively trying to prune and plant my long and short book, but obviously with just so many people just going like blindly, just, hey, I'm buying all these zero DTEs, whoopie whoop de doo. It almost seems like it's overcomplicated to oneself. It's like, just, it's kind of almost implying, hey, you should just kind of be an idiot too, and just give in. But obviously, we have to be aware of economic reality in terms of trends, tails, and trades. So, how do you kind of follow the trend, but without being too obsessed with the trade? Because everyone is, I guess not everyone, but you see the gains in the trade, whereas obviously the trend is really where we want to be. I'm sorry. Yes, the trend is really the move where you want to be, but obviously the trade is just kind of, it's overdone. It can just keep going. Top of the range makes new highs. Obviously, I think the anxiety meter is kind of there.
So, Alan,
Yeah,
I'll tell you a couple
yeah,
of things, right? So, activity does not mean progress. Okay, I'll repeat: activity does not mean progress.
correct.
So, for returns on a portfolio, first of all, returns does not mean the process was always right, and one has to be really, uh, really cognizant about, are you attributing correctly? For example, uh, the famous poker player, I'm trying to remember her name. She was on one of the Hedgeye guest speakers. She has written a bunch of books. Annie Duke.
And you do.
Annie Duke. So she has a specific term for this called resulting. And I actually met her once at a VC firm's office, a really famous VC firm in Silicon Valley. They have a 16 in their name, right? I wouldn't name them, but uh, over there, she was actually giving this set of advice, or her nuggets, to all the partners over there who are actively going out and seeking deals and looking for opportunities, etc. Right? And in many ways, VC investing, portfolio investing, uh, is similar to playing to a certain degree. Okay, not completely, but to a certain degree. And the key nugget for me, out of many nuggets that you gave, was resulting. So when things go right, calling oneself a smart person, and when things go wrong, attributing them to bad luck, is a very easy and lazy mechanism that human brain can do the attribution with. Okay, it's a very obvious mechanism to do, but one can steer clear of it by, I use journaling. I'm not advising that it's possible for everybody to do it. So first things first is one has to figure out what frequency of investment portfolio allocation adjustments is suitable for me and feasible for me. So for example, you mentioned you have a job, then you determine that of the 40 hours of your job, outside of that, you want to probably give 20 hours to your family or more. you know uh, you want to sleep 40 hours, right, in a week. So what is left? How much time do you want to give to this, right? So that's first. Determine how much time you can allocate, one, to learn, and two, to actually play the game. Then second, for that level of time, what is a comfortable level of expectation uh, that you have, be it in form of returns or be it in form of commitment of actions that you're willing to do, right? Because you don't want to be distracted. Like, you're probably working, you're in your important office meeting, or you're working with your client or whatever, and suddenly you're like, "Ooh, that alert came. Now I need to act, right? Where's my app? I want to do that buy or sell or whatever, right?" You don't want to have that. So some folks have automated that kind of thing. Ernie Chan has written a really good book, or bunch of books on this, where he has said that he has given steps like this, what I'm describing to you, right? Like, first define like how much time you have available. Is it early morning? Then you do just futures, and that 5 a.m. to 8 p.m. 5 a.m. to 8 a.m. space. Then 8 a.m. you go to office, or in the night or whatever. You define that, and you, for the rest of the day, you can decide you can automate, or you can just do normal portfolio allocations like people do for 401k. Set it and forget it, right? I've read so many retirement surveys by the there's these institutional retirement surveys that are done by larger 401k providers, the annual active user. So you know how Facebook has this measure called daily active user, right? DAUs or
Sure.
MAUs. So similarly, the annual active user, meaning a person who actually logs into the 401k portal or 403b portal, is 28%. So those people just set it and forget it. And believe me, some of those people have beaten all other active market participants hands down. So the reason I'm sharing this with you is that I wanted to emphasize on what I mentioned. Activity does not mean progress. And if you don't have bandwidth, then again, this is not an advice, right? If you don't have bandwidth, then figure out what's feasible and suitable to you, because the benchmark is really, really tough to beat. If you keep S&P 500 as your benchmark, keep in mind S&P 500 also has huge drawdowns, right? So for example, when
Right.
March 2020 happened, there was a 35% drawdown. If that is not suitable for you, then your benchmark could be VBINX, VBINX. That's the Vanguard fund for 60/40. It doesn't have 35% drawdown, but you can look it up how much it has. So long story short, figure out your time allocation you can give, figure out feasibility, figure out how much activity you can do, and then decide you want to be active or passive. If you want to be
So
passive, that's fine.
just kind of as a follow up to what you just said, because I think the relation to poker is important. I think there was the DiMartino Booth interview was great because one thing they mentioned, there's a bit of a chess element and a bit of a the hand you're dealt element. And so in March of 2020, that's actually when I discovered Hedgeye. I understood the concept of obviously like things that are important longs and things that because of the activity and the volatility of being short. So to me, I'm not married to anything. I will curve anything. I'll just be in and out, and I just have a pile, and it's just about building the pile. But it's just to me, a lot of the times I find myself sitting on my hands, and I'm just like, man, like obviously um, you want to be more active, and I think you my spot on in terms of the time, because I think that's something that maybe not a lot, because I think everyone just assumes that we're all like just glued on it, and if I mean there's a lot of emotion tied to it, so I'm sure shit many people are, but when I guess when you're trying to prune and plant and then use the pile elsewhere in terms of real estate or expanding a business, things like that. To me, it's okay to be, active for in terms of knowing the quads, knowing the duration of certain trades and certain allocations and stuff like that. And I suppose what I'm asking is how do you just not get caught up in all this noise that's just kind of going on right now? Obviously, there's a lot of coverage on
Alan, just turn it off.
the options market.
Alan, I'm gonna interrupt, buddy. Just turn it off, man. Just try to just block it out. Whether if it's bothering you, again, like I got, I'll give you a little secret. I read, I read nothing of the Wall Street. I'd read nothing other than important stuff in regards to biographies or things that are going to help me build myself as a person, right? So the David Goggin books, the Thinking Fast or Slow, the all those kind of things, right? Building your character, building your person as the TVs are on here in in the office on mute, and that's the only time I ever look at or see CNBC. And I finally convinced the guys to turn on Bloomberg TV for the majority of rather than watching the nonsense on CNBC. But even Bloomberg's not that great.
And same with your phone notifications. You can turn off your phone
Yeah. So again, I
notifications
mean, like
too.
the noise is the noise, and but that's a whole nother conversation. Excuse me, for another day. I think the biggest thing here is the noise is relatively focused on the U.S. And the FOMO is here in the U.S. If you look globally, and that's the beauty about our process, is that it's a macro landscape. We can go anywhere. You've got bullish trend in China. You've got bearish trend in Nikkei. You got bullish trend in DAX. You're bearish on Microsoft, neutral on Apple, which means wait and watch, do nothing. Amazon is bearish, right? You go up down the list in terms of you've got multiple things that you can do inside of the commodity complex, both from bullish and bearish trends. Meta, Google, Netflix, Tesla, right? You get the risk ranges, you can see them. So again, there's like lots of places to to go and look. And the other thing too is it doesn't, the noise is the noise, right? And blocking it out, it can be very hard, Alan. But when you are freed of it, it's amazing the amount of extra time that you have in a day, either to continue to build upon your process, if that's like what is something that you're interested in, and like myself or Trend, who we're it's something that we're incredibly passionate about, and that's what landed me here at Hedgeye, right? It was basically my favorite thing to do outside of hanging out with my family. And so I spent a lot of time just trying to harness it and diving into the process and building out what kind of what I have today. But it continues to evolve every day. I find something new that I can tweak or add to my process, and it keeps. Ideally, the goal is to keep getting better and better every day, right? So the trend is spot on, and I've said this a couple of times, either here or on a beginner's guide. But you got to understand and try to first, before you even make a trade, really, you got to try to harness and really dig deep and take a step back as to what is the goal here. Is it compound capital? Is it preserve and protect? And again, I would say our fundamentals is preserve, protect, and compound. So it's trying to do all three, and that's like really the foundational aspect of Hedgeye. But in this environment, I'm more so talking about like this environment. How active can you be in the chop bucket? The chop right now may feel investable, going to Eric's point in regards to. But that's mainly because we're right on the top end of the investable bucket, which is 19 and below. So this is where at the low end of the chop bucket, it can feel a little bit more like the investable bucket, but we are still squarely in the chop. You've got a day up, a day down, 2 days up, 2 days down, right? That's the definition of the chop. And you've got big, relatively large volatility swings. Almost everything that's happening is very quad four oriented, especially if you take a bird's eye view or kind of zoom out a little bit and you look at what's happening in oil and oil demand, right? And the signal there. You're looking at natty gas. I mean, that thing can't catch a bid. You're looking at what's happening in the U.S. Treasuries, the dollar. Over in Asia, it's you're getting China and the related relative kind of boost around there in terms of exposures that might benefit from increased exposure, increased demand and activity inside from a GDP standpoint within China. So those related entities are working. The signal's getting better. So again, I mean, I think it's just it's one of these things where you take that general view and that more grander view, and it becomes a lot easier to block out the noise. And I'll tell you this: it's amazing how much additional time you have for other things. And again, you can do whatever it is, whether it's, to your point, Alan, building a business. And that's the other beauty of Hedgeye, is that you don't always have to deploy it on inside of your portfolio, though obviously that is what it's geared towards. But I can't tell you the number of folks I've, whether it's at the regional events or just through my general engagement with Hedgeye Nation, that deploy it within their business or making better investment general investment decisions in terms of pivoting, right? Whether it be selling a piece of real estate or becoming a lender inside of the real estate market rather than being a buyer of assets, right? So you're kind of taking on the credit, and you're moving to the credit side, that kind of thing, right? So just pivoting across the board, and I think that's a huge piece within Hedgeye that goes beyond just the portfolio allocations and the portfolio construction. It really can disseminate into the real world, whether it's be running a business or making decisions inside a business, or the accountability, transparency, trustworthiness that is another kind of three foundational components that we really believe on here at Hedgeye.
Thank you so much.
Man.
Thank you so much, sir. It's a big pleasure to be part of Hedgeye and just what it is and the value.
Absolutely, buddy. No, appreciate it. Palmer, you jumped on. I don't know if you had some additional content or color to provide here in this conversation, but
well, I was gonna. I had. Can you hear me?
Yeah,
okay?
We're good. Yep.
I had to jump off for a minute and take care of something. There was a guy earlier talking. I was just going to mention two quick things. He's talking about just savings rates at banks. Investopedia publishes a monthly rundown of like the top savings rates for all banks across the country. And there was looking this morning for work. We've got a bunch of cash we need to park somewhere. We're trying to figure out where to put it. And there's I can't remember what the bank was called, Imprimis or something like that, but they've got like a 5% APY just savings account, and there's no term, no CD, nothing. So if anybody's looking to park some cash somewhere. And then he also had commented on the trying to figure out what trend is. I know it's not a perfect proxy for it, but I use the bridge bands and I run them on TD Ameritrade. I run them at 63 days and I run them at 15. And while it's not perfect, it does give a pretty good proxy for kind of establishing a trend that you can utilize, kind of like how Keith does, and at least helps you risk manage a little bit better. I found that's worked pretty well for me in terms of kind of seeing where how a position may be breaking down or where it may be headed. Like I said, it's not perfect, but I use that 15-day as kind of a trade level, and it's definitely worked to save me a few times on some positions. So just a thought on that.
Awesome. Well, I think with that, we're going to kind of wrap it up tonight. So appreciate everybody for jumping in. It's been a great session as usual, and we'll see you guys next week, same time, same place. All the best, everyone.